Hello and welcome to this video from Next Level Purchasing's online class, Finance for Strategic Procurement. In this video, I am going to show you how to set up a spreadsheet to calculate double declining balance depreciation on the purchase of an asset. So here you see that I have set up a spreadsheet the way it's set up in the class with a column for the year, as well as column headings for beginning book value, accelerated depreciation percentage, accelerated depreciation expense, greater of straight line versus accelerated, depreciation used, and ending book value. Now in this particular example, your organization has purchased an asset for $30,000 in brand new condition. That asset will have a useful life of 10 years, and it will have a salvage value of $5,000 at the end of those 10 years. And you want to use the double declining balance depreciation method to determine its book value at every year. Now, the first thing we have to enter is the beginning book value for this first year, and that is how much you purchased the equipment for. In this case, it is $30,000. The next thing you have to do is figure out the accelerated depreciation percentage. If we were to do straight line depreciation, a percentage that you would use is simply 1 divided by the number of years of the useful life. In double declining balance depreciation, you need to multiply that by 2. And by doing that, you see that our accelerated depreciation percentage is 20%. Converting that percent into dollars is what we do to get our entry for the accelerated depreciation expense field. And we simply multiply the beginning book value for the period times the accelerated depreciation expense. And this number will be different for each year. As the asset gets older, it will depreciate, meaning it will be lower in value, and it will depreciate, therefore, by less each year. One of the rules of double declining balance depreciation is that you use the depreciation amount that is the greater of the accelerated depreciation expense that we calculate here and the straight line depreciation amount, which would basically be calculated as the purchase price minus the salvage value divided by the number of years of useful life. So in this case, we have a $30,000 asset that will have a salvage value of $5,000. The difference of that is $25,000. And divide that over 10 years means that the year-by-year straight line depreciation amount would be $2,500. So here you have to do something a little bit creative in Excel. You can use the max function. This function teaches you or helps you attain the larger value among 2 or more values. So here's how we do that. Equals max, and what do we want the higher number to be? It's either going to be the accelerated depreciation expense, so I'll just click on that cell, or it can be the straight line depreciation amount. And I'll type this formula out to illustrate how it's derived. So $30,000 purchase price minus $5,000 salvage value. You divide that by 10 years of useful life, and Excel will tell you which is the larger of the 2. Obviously, you can do this just by looking at it, knowing that $6,000 is larger than $2,500, but this can be helpful as you copy the formula down, as we will later in the video. Now, there's another rule that applies in double declining balance depreciation, and that is you would use the greater of the straight line versus accelerated depreciation value unless using that value would take the ending book value below $5,000 or below the salvage value. So I can use an if function in Excel to make sure that that does not happen. So we do that like that. Equals if. So if the beginning book value minus the greater of the straight line versus accelerated is greater than the salvage value, which is $5,000, then you would simply use the greater of the straight line versus accelerated. However, if it's below $5,000, then you would use the difference between the beginning book value and the salvage value, and I'll type that in. So in this case, the Excel spreadsheet tells us to use this amount because obviously that depreciation will not take the ending book value below the salvage value. And we can see what it does take it to. We take the beginning book value and subtract the depreciation used, and indeed, we have an ending book value in excess of the salvage value. So now we can go on to the second year. Now the beginning book value of the second year is the same as the ending book value of the first year. So to put that number in there, I'll just type equals and I'll select that cell up there. By doing so, what we are telling Excel to do is to go up one row and go over to the G column to select the value. I do this for a couple of reasons. The first reason is it ensures accuracy. If you're typing two numbers in here and here, then there is a chance that human error could come into play and you could type in the wrong value and mess up your entire spreadsheet. Another reason is that you can copy that cell down and it will do the calculations for you. Speaking of copying, that's what we'll do to our accelerated depreciation expense. It's going to be the same value throughout the entire useful life. And we'll copy down this formula because that gives us our accelerated depreciation expense for the year. Notice that it is lower than it was the first year, and that's because the book value for the asset is lower. The asset has depreciated. We can copy our max function down as well, and we'll see that that works correctly, that $4,800 is indeed greater than the $2,500 that you would use for straight line depreciation. We can copy down our if function as well, and we will use the 4,800, which means that we will not be going below our ending book value, or our ending book value would not be going below our salvage value. And again, that is the case. And now that we have formulas in all 6 of these cells, we can simply highlight that range, put our pointer over the bottom right corner of that range, and double-click to populate the rest of our spreadsheet. A couple things that I would like to point out to you here. In the 5th year, we see that the accelerated depreciation expense is actually lower than the straight line would be, so we would use the straight line depreciation. Another thing that I'd like to point out is that here in the 7th year, using the greater the straight line versus accelerated would take our ending book value below the salvage value, so in that case, we use a different depreciation amount. And then, in fact, we don't use any depreciation for these last 3 years because we can't go below the salvage value. So that is how you set up a spreadsheet to calculate double declining balance depreciation. If you'd like more information and more insights how this type of spreadsheet would be used in a procurement situation, I encourage you to enroll in our online class called Finance for Strategic Procurement Part 1. You can learn more about that class at nextlevelpurchasing.com.